Hey everyone, welcome back. It's Matt and Anthony from the Pitti Group Wealth Management, and this is the Finance Things in Life. Today we're going to be talking about the 6 key ages of retirement planning. So kind of lay the groundwork for 6 ages that you should kind of keep in mind as you're getting closer to retirement to kind of better prepare yourself.
Yeah, what you should be doing during those times. Just a few quick facts.
Yeah, kind of the roadmap. The roadmap to retirement.
Ooh,
The 6.
nice ring to it.
Yeah, the 6.
6 exits.
6 exits. That's what I was thinking
Yeah,
about.
I could see it workshopping in your head.
Yeah.
Yeah.
All right. So the first one, pre-age 50. So not exact age, but before you get to age 50, I mean, those are the times where you really need to start contributing, making sure you're putting money away into your retirement.
Your assets.
Yep. Not only into your retirement plans, but also IRA, if that is an option.
Yeah. We talk to a lot of people, and some don't realize that you can contribute to an IRA if you're still contributing to a retirement plan. So you've got your couple options. You've got your traditional IRA and your Roth IRA. Right now for 2024, you can contribute up to $7,000 into that IRA.
We're in 2025.
Oh my gosh, 2025.
Yeah.
Wow. Oh,
We're almost 9 months into 2025.
man. You can tell it's been a long year. 2025. 7,000.
Yeah.
Yeah.
So if you're under the age of 50, you can contribute that 7,000 into your IRAs.
Yeah, and then it just gives you another option for retirement when you're taking money out. That 401k, if it's a taxable account, you're taking money out, you're getting taxed on that because you've already gotten that tax advantage when you're putting the money in. For the Roth IRA, when you take that money out, you're not getting taxed. The money you put in was already taxed. They're not going to tax you twice.
Yep.
So that's one of your options. For the 401k side or a 403b, whatever your employer-sponsored plan, at the very least, you should be hitting your match if you have one. It's basically free money, so don't leave any money on the table. Take what you're given. If you don't know, ask your employer what the plan details are. Make sure you're aware of everything they offer you.
Yeah, and that's where it can come into play. If you're a 401k or 403b, your retirement plan, if it's only offering a traditional, that's where it might make sense to do that Roth IRA contribution, and vice versa. Or sit down with your advisor and kind of put together a retirement plan, a financial plan, and see what makes the most sense.
Yeah.
So.
Yeah, and if you've already been contributing to an IRA, it's not too late. You can also do a Roth conversion. So you can convert that IRA into a Roth, and you can do that strategically, over a set period of time. So you're not converting a lump sum all in 1 year. You can do a little bit at a time to make sure it's not as much of a taxable burden to you in the year that you're doing it. So there's definitely some options available to you.
Yep. All right, so the first one was pre-age 50. That second key age is actually age 50. So once you turn 50, that is when you can start doing the annual, the increase in contributions to your retirement plan or your IRAs. So if you are currently maxing those out, prior to age 50, now you have the step up in contributions you're now eligible for. So a great way to catch up if you need to. Maybe for the first few years that you're working, you weren't able to put money away. This is where you can obviously increase those contribution amounts.
Yep. Yeah, it's a great tool to take advantage of. You can do it in the employer-sponsored plan as well as the IRA. If you don't know those details, obviously feel free to ask a financial professional. HR should be able to tell you about that as well.
Yeah. So for an IRA, that extra contribution is an extra $1,000. So you could do up to $8,000 into your IRAs.
Yeah. Should also start looking into long-term care. if you haven't already. I think one of the fact sheet we were looking at earlier stated that I think 70% of people 65 or older will need some sort of long-term care. And that can rack up fairly fast. We've done a podcast about some long-term care insurance prior. Yeah, those expenses will eat away at your savings.
Right. Yeah. And, and you don't want to wait too long. I mean, it's only going to get more and more expensive.
For sure.
Once you turn a certain age, you probably kind of get, the expense is probably too much. It's not even worth it.
Right.
So the earlier you look into long-term care, even though it seems like a ways off, it probably makes sense to do that. Third key age, age 59 and a half. So 59 and a half is the age where you can now start taking distributions from your retirement accounts or IRAs and avoiding that 10% penalty.
Yep. All that hard-earned money you had saved up, finally start using it.
Right. Yep. Yeah, so prior to that, age 59 and a half, if you were to take a distribution, and it wasn't for hardship withdrawal or anything like that, you just needed to take a distribution, you would pay not only tax if it was a traditional IRA or traditional 401k, but then you also get hit with that 10% penalty. So the government's really pushing, you as the investor and the pre-retiree to really leave that money in that account.
Yeah. I mean, a lot of people for years weren't saving enough for retirement, relying on Social Security. Pensions got tossed away for the most part. So they've really started to initiate a lot of programs to incentivize people to start saving more with the catch-up contributions, higher contribution limits. They're now rolling out new laws for employer size. If you're over the 10 people, you have to have some kind of retirement plan in place for your employees. They've seen a big, I guess, a deficit as far as people saving for retirement. So I'll give them a little bit of kudos there as far as trying to help out that side of it.
Now, the next age is kind of a gap, but between the ages of 62 and 70, but essentially that's your Social Security benefits. So, you can start taking Social Security as early as 62, and obviously your benefits are going to be reduced based on your full retirement age. And I think most people that are, our age are, I forget what the cutoff is. I think it's 1960 or later. Their full retirement age is 67. But that's when you can start taking your Social Security benefit. So depending on your retirement date and what your income needs are, maybe you want to take Social Security earlier. If you wait till 67, that's going to be your full retirement age. And then you can also wait till 70. So if you wait past age 67, your retirement benefit your Social Security benefit is actually going to increase every year that you do wait. After 70, it's not going to increase anymore. So
just take it.
Just take it. Some things to keep in mind with Social Security is that your income is limited to how much you can actually make if you are taking Social Security before full retirement age. So if you're still working, maybe it doesn't make sense to take Social Security at the same time.
Yeah, either or. Consult with your advisor to see what they think. There's a lot of ways that we can calculate what the break-even point is, depending on when you take it. So depending on your situation, it might be a little different. Your neighbor might be taking it at 62. You think you have to do the same thing, but everyone's situation is different. So make sure you consult with someone about that.
Yeah. And the only, people ask, like, what should I do? When's the best time to take Social Security? The only, way to really be able to give you the correct answer is if you can tell me when you're actually going to pass away.
Yeah.
Most people don't know that. But if you do have longevity in your family, typically it pays to wait. If you're going to live, late 70s or later, if that's what your life expectancy is, then typically waiting makes the most sense. If you don't have longevity, maybe it makes sense to take it earlier.
Take it while you have it.
Yeah. Obviously, how much you've been able to accumulate in your retirement plans also comes into play here. Because if you're retiring at 62 and, you're limited to how much you have in your retirement plans or the money that you're going to live off of, obviously maybe you don't want to wait and delay Social Security because then you're going to be eating into your nest egg.
Yeah.
So that's all something that, running that financial plan kind of help give some guidance to you. Next age, 65. Actually, 3 months prior to age 65. So that's when you need to sign up for Medicare. If you don't do that, if you wait, you could face penalty. You could face an increase in premiums. Your Medicare benefits may be delayed. So even if you're not going to take Medicare at 65, maybe you're still working, you still need to, register and
apply for it.
So
yeah, I think Part B, you're able to wait a little bit. I think the limit is 8 months after. What is it, 8 months after your last employment.
Yeah, leaving your employer.
But anytime after that, you would get penalized if you wait any longer. So making sure that you're within that window, earlier the better.
Yeah, and it's something that you usually don't think about. Is Medicare, especially if you're still working. So it's really important. Especially because you could get those penalties or increase in premiums over your lifetime. So
yeah. One thing about medical costs is they continue to go up
every year. It's unbelievable. I know we've done podcasts on that as well. It's just it's mind blowing the increase that you see year over year on healthcare and medical insurance and everything else. So
booming business.
It is a booming business, right?
Everyone's living longer, so they just need more and more medical care, and the cost of that is just going to continue to increase.
Yep. So that next age is 73. So 73 is the year that you are required to start taking your minimum distributions from your retirement plans or your IRA. So that is essentially a way for the government to start collecting taxes.
Yeah.
I mean, to keep it simple, that's what they're looking to do.
They want their money back.
Yeah, because you don't need to do it for a Roth because that's already been taxed. So they don't want to. They're not looking to take that. They want the tax money from your IRA. So keep that in mind. So at age 73, the year you turn 73, you need to take those distributions.
It has to be done by the end of the year. And if you don't take that distribution, you're getting a 25% penalty on what you're not taking. So a very hefty penalty for some people. If you've got a decent balance of your retirement savings, you've done a good job of your working years, and you forget to take an RMD for some reason, that's going to be a whopper of a penalty.
Yeah, and how that distribution is calculated, they look at the balance, the end of the prior year. So if you turn 73 this year, they would have looked at your balance December 31st of 2024, and then based on the table that they use in your life expectancy, they calculate that required minimum distribution.
Yep. Yeah, it gets refreshed every year. A good way of going about that is, if you're comfortable or familiar with having like a paycheck coming in every couple weeks or every month, you can set up auto distributions from that account so you don't even have to think about it. Keep you out of the weeds. I know for us, for example, we send out reminders for people if they haven't taken their RMD, and then we usually try to have those done by late November, early December.
Yeah. Yeah, I mean, we try. Some people like to wait till the end of the year. Typically, the mid-December is the
Right.
last time that we'll let someone take it. We just don't want to.
The
We don't want to
ripcord.
risk it going past December 31st. But your distributions. So whether it's your IRA distributions that are coming out, those all count towards your required minimum distribution. So you can take it at any time. You can take it in the beginning of the year. You can take it throughout the year. You can take it on a monthly basis. It doesn't matter. It just has to be that amount. And as long as you take it by December 31st, you're good to go.
Yep.
One thing to keep in mind, though, is that you have a requirement distribution for each account.
Yes. Good point. I was
So-
just about to say that.
Yes. So if you have multiple IRAs or a 401k or old 401ks or old 403bs, sometimes you might have an advisor that's keeping track of that for you for the accounts you have with them, but you need to make sure you're taking it everywhere. So whether consolidating is the right thing to do or keeping track of it yourself, you need to make sure you do that.
Yep. That's a good point.
Yeah.
Yeah, there's a lot of people that we meet with that have retirement plans in a few different places. So consolidating definitely can help with that. I know we didn't touch on it earlier, but in your early working days, if you've got old retirement plans, rolling them into an IRA or a current employer plan, all the same, just helps as far as tracking, helps as far as your diversification, what you're invested in, keeping track of that. It definitely doesn't hurt to consolidate some of those accounts.
Yeah. Yep. And another thing to keep in mind is your required minimum distribution, you can take it all from one account.
Yes.
So, let's say you have 3 different accounts and your total required minimum distribution is $30,000, but one of them's 20 and the other 2 are 5. If you take it all from one, that's fine. You just have to make sure you take that entire amount.
Yep.
So,
Good point.
one last thing.
But wait, there's more.
There's more. Infomercial. Anyone that is typically giving to charities, and you want to do those charitable contributions from your IRA, you can make those qualified charitable distributions directly from your IRA. They count towards your required minimum distribution, and you don't have to pay tax on it. So, if you've been kind of writing a check from your checking account and giving it to whatever charity you want, it may make sense to look at doing a charitable qualified distribution. Counts towards your RMD, and then it's you're not paying tax on that.
Yeah, that's a great point. I feel like a lot of people should be looking into that. As far as making charitable contributions, just 2 birds with 1 stone.
And then the last kind of key age is just post 70. Making sure that you have all your beneficiaries in place. Your will's updated. Trust documents, power of attorneys.
You're getting your kids involved.
Because that's kind of the age where, you're moving past all that. Maybe you have cognitive decline. Just making sure those things are in order is truly important.
Yeah. Make sure your ducks are in a row, because you never know when that cognitive decline will happen, or really anything in life will happen. You just want to make sure you're prepared for the worst case scenario, so you're not making a large financial mistake. You could have accounts that are taxed improperly, penalized improperly, if you don't have the right documentation, things in line.
Yeah. Yeah, and at that point, if you're in your 70s, you probably have kids that are in their 30s, 40s, maybe even 50s. You're probably starting to have some grandchildren. So, marriage, divorce, deaths, births, a lot of things are changing because your family tree is essentially growing. So you want to make sure that is, continually updated and you're keeping track of it. I would say, your annual review with your advisor, it's one thing that you should just, every time, these are the beneficiaries, just make sure that, everything checks out. And then if you do have one of those life events, it's just a simple form, update the beneficiaries. So,
Yep. Great point.
Yeah. So 6 key ages, like we said, pre-age 50, right? Making sure you're making your contributions. Age 50, now you can start doing the step-up contributions. 59 and a half.
59 and a half.
Penalty-free withdrawals.
Yep.
62 to 70.
Social Security.
Social Security benefits. And, like I said, those really need to, work on what makes sense for you with those. Sometimes 62 is not the best age to do that. 65, 3 months prior to 65 for
64 and 9.
Medicare enrollment. And then, let's see.
You go to 73?
Was it? I think 73.
Yeah, 73 yeah. RMDs.
73 RMDs, and then post 70s.
Yep.
Making sure everything's updated and kind of buttoned up.
Yeah.
So,
beautiful.
That was a quick roadmap, right?
Yeah.
That wasn't too bad.
No, not at all. Yeah, the main idea is
retirement simplified. It's like
right. I know it sounds so simple that way.
Simple.
The main idea is to make sure that to kind of trigger any thoughts like, oh, I need to do that. So if this perked any thoughts, or if you have any questions off of anything that we discussed, feel free to reach out and ask away. We're happy to help any way we can.
Yeah, we appreciate you guys tuning in. And actually, if you have, because obviously depending on who's listening, or our listeners might be a little younger, but if you have parents that they're approaching any of these ages, it's not a bad thing to just say, hey, mom, dad, even grandma, grandpa, as you're getting to this age, 3 months to Social Security or Medicare.
Yep.
Age 65, you need to make sure you're taking care of that. Or, have you thought about increasing your contributions because now you're eligible for a catch up? Or, make sure
you don't know what you don't know.
Yeah. So, but we appreciate you guys tuning in.
Yeah. Thank you very much.
Yeah. Any other questions? Feel free to reach out, and we're always here to chat.
Thank you.
Thank you.